Chapter 7, Long-Term Assets. We'll be starting Part B now, Cost Allocation. Learning Objective 4, Calculate Depreciation of Property, Plant, and Equipment. When people talk about cars depreciating, they're usually talking about how much the value of the car has decreased. This is a dictionary definition of depreciation. It's a decrease in the value of an asset. That is not what we are talking about when we talk about accounting depreciation. Accounting depreciation is the allocation of the asset's cost to an expense over time. If depreciation were calculated based on the dictionary definition, we would need to estimate the value of every long-term asset a company owns every period. Due to the difficulty involved, long-term assets are not adjusted to fair value each period. Rather, long-term assets are recorded at their cost, which we discussed in previous videos, and then that cost is allocated to an expense over a period of time. So for example, if you have an asset cost and it has a 4-year benefit life, we're going to allocate that cost to each period so that the cost incurred is the total cost, and then you allocate it to the benefit it provides over the 4 years. We've already seen a journal entry for recording depreciation in the past, so this should be a review to you. A local Starbucks pays $1,200 for equipment with a useful life of 4 years. Record depreciation expense in the first year. We'll think back to the adjusting journal entry for recording depreciation. If we have a cost of $1,200 and it's going to be useful for 4 years, then we record depreciation of $300 a year. Remember, the debit is to depreciation expense on the income statement. You're allocating that cost to an expense. And the credit, remember, is to that accumulated depreciation account. Remember, accumulated depreciation is a contra asset account, which means it has a normal balance of a credit. So if you were showing this on the balance sheet, you would show your equipment at cost, what you paid for it, $1,200, minus your accumulated depreciation of $300 to get you a book value of $900. Book value is also referred to as carrying value, and it's equal to the original cost minus the current balance in accumulated depreciation. Notice that by increasing accumulated depreciation each period, we are thus reducing the book value of the equipment. Do not ever record a depreciation journal entry with a credit to the asset account, such as equipment. You want to keep these separate. You want to be able to look and see how much the equipment originally cost and how much depreciation you have taken on it. You have to record the depreciation journal entry as a debit to depreciation expense and a credit to accumulated depreciation. When calculating depreciation, there are 3 factors that we need to establish at the time the asset is put into use. The first is the service life, also called the useful life. It's the estimated use the company expects to receive from the asset before disposing of it. As you see in the previous example, we have a useful life of 4 years. So that would be 4 for our useful or service life. Residual value, also called salvage value. This is the amount that a company expects to receive when they sell the asset at the end of the service life. So that $1,200 espresso machine has a 4-year useful life. At the end of the 4 years, they may sell the asset or they may just get rid of it. So how much are they expecting to receive in cash for that espresso machine? That would be your residual value. Lastly, depreciation method. The pattern in which the asset's depreciable cost is allocated over time. Depreciable cost is the amount that we're actually depreciating. We're going to depreciate from the original cost of the asset minus the residual value. So you want to only depreciate down to residual value. For example, that $1,200 espresso machine, if it had a residual value of $200, meaning at the end of the 4-year life, they expect to be able to resell it for $200. Our depreciable cost of the espresso machine would be $1,000. The $1,200 cost minus the $200 residual value gives you a depreciable cost of $1,000. We, as a company, have to determine which depreciation method we want to allocate that $1,000 using. So there are 3 different methods that you can use. We will only talk about straight line in this video. We'll pick up in the next video with the other 2, declining balance and activity based. But those are the 3 most common methods used. Straight line allocates an equal amount of depreciation to each year that the asset has a useful life. It's the easiest one to do and the most commonly used depreciation method for financial accounting. Declining balance is an accelerated method, meaning that more depreciation expense is taken in the earlier years of the asset and less is taken in later years. Declining balance is often used for tax purposes. Lastly, activity-based. Activity-based calculates depreciation based on the activity associated with the asset versus years. So if you're talking about a piece of equipment, instead of saying that equipment is going to last us 7 years, that equipment might last us 250 units. So we'll depreciate it based on the units. So the first one we talk about, and the easiest to understand, is straight line depreciation, where we allocate the equal amount of depreciable costs to each year of the asset's service life. To calculate depreciation expense for a given year, we simply divide depreciable costs by the number of years in the asset's life. This is what you've been doing, except we're taking residual value into consideration now. So for example, we have a truck that costs us $40,000. Its estimated residual value is $5,000. And at the end of its estimated service life is 5 years or 100,000 miles. Don't worry about the 100,000 miles right now. We'll get to that when we get to the activity based. Right now, just focus on the years. So to calculate depreciation expense, we take the asset's cost minus residual value and divide it by service life. You could also say that that is the depreciable cost divided by service life. So in this example, $40,000 cost minus $5,000 residual divided by 5 years, we're going to take $7,000 of depreciation per year. This is called a depreciation schedule. You need to be familiar with it and be able to fill one of these out. So Little King Sandwiches is the company we're working with now. Notice that we have a year column, depreciable cost, depreciation rate equals the depreciation expense. So remember, the depreciable cost times our rate is our expense in accumulated depreciation book value. So book value at the beginning is the same as the cost because we have not taken any depreciation yet. In year 1, we have a depreciable cost of $35,000. How do we get the 35? Remember, our cost of $40,000 less our residual value of $5,000 gives us depreciable costs of $35,000. We want to multiply that times the depreciation rate of 20%. Well, how did we get 20%? We said the asset has a useful life of 5 years. So we're going to take 1/5 each year. So 1/5 is equal to 20%. So our depreciation rate is 20%. So 20% of our depreciable costs gives us $7,000 for depreciation expense. Our accumulated depreciation at the end of the year is $7,000. We haven't taken anything other than 1 year's worth of depreciation. So in the first year, our accumulated depreciation equals $7,000. Our book value at the end of year 1 is $33,000. Our cost minus our accumulated depreciation is $33,000. This is how you fill out the rest of the chart. Notice this is straight line depreciation. So your depreciable cost remains the same for each of the 5 years. 5 years because we're talking about 5-year useful life. Depreciable cost remains the same, the rate is the same, and the depreciation expense is the same. Straight line, you're allocating the same amount over the useful life. So you're taking 20% 5 times. So your depreciation expense is $7,000 each year. Our accumulated depreciation increases and our book value decreases. So in year 2, our accumulated depreciation is equal to $14,000. Our prior year accumulated depreciation plus the current year depreciation expense gives me $14,000. Our cost of $40,000 minus our accumulated depreciation gives me a book value of $26,000. Continue this down and notice in the 5th year, our accumulated depreciation is equal to $35,000. Our cost of $40,000 minus our $35,000 accumulated gives us a book value of $5,000. And that is our residual value. It won't happen in this method, but in other methods it could. Do not depreciate below residual value. That's your stopping point. Your book value can never go below residual value. So what if the delivery truck was purchased during the year, say on March the 1st, instead of on January 1st? In the previous example, we assumed they bought it at the very beginning of the year. But not every company buys assets on January 1. They buy assets throughout the year. So in this example, we're saying, what if he had bought it on March the 1st and then used it for 5 years? Remember, our annual depreciation is $7,000. Our cost minus our residual value divided by 5, $7,000. In the first year, we only need to depreciate for the portion of the year they actually owned the asset. They didn't own the delivery truck for 12 out of 12 months. How many months did they actually own the delivery truck? March, April, May, June, July, August, September, October, November, December. They owned it for 10 out of the 12 months. Beginning of the month, include the month. If this had said March 31st, you would not include the month, but this is the beginning, so include it. So in year 1, we would take $5,833 of depreciation, 10/12 of the amount allowed for straight line. Then in years 2 through 5, it would still be $7,000. Nothing changes in those years. They owned it those entire years, so you're going to take the $7,000. Well, at the end of year 5, have we reached our depreciable cost of $35,000? No, because in year 1, we only took 10/12. So if you have a partial year depreciation, you go into the next year to pick up the remaining 2 months that you didn't take in the first year. So 7,000 times 2 over 12 is $1,167. Gives you your total depreciation of $35,000. Change in depreciation method. Remember, depreciation is an estimate. The amount of depreciation allocated to each period is based on management's estimates of service life and residual value. Management needs to periodically review these estimates. If a change in estimate is required, the company changes depreciation in the current and future years, but you do not change it in the prior years. So, assume that after 3 years, Little King Sandwiches estimates the remaining service life of the delivery truck to be an additional 4 years, for a total service life of 7 years, rather than the original 5. Little King also changes the estimated residual value to $3,000 from the original $5,000. How much depreciation is taken in years 4 through 7? So we have 2 things going on here. One, the total service life changes, and 2, the residual value changes. So we've got to do a change in depreciation. So as you'll see, we have a cost of $40,000, a useful life of $5,000, and a useful life of 5 years, and a residual value of $5,000. So we took our $40,000, subtracted the $5,000, and divided by 5 to get $7,000 per year of depreciation. In our example, it tells us that at the end of 3 years, we need to do a change in depreciation. So we need to determine how much depreciation has been taken for 3 years. So at $7,000 a year, they have taken $21,000 of depreciation. That's our accumulated depreciation amount. So what is our book value at the end of year 3? Well, our cost was $40,000, and our accumulated depreciation was $21,000. So we have a book value of $19,000. So our book value is $19,000. It tells us in the example that our residual value has changed to $3,000 from $5,000. So take your $19,000 book value, subtract the new residual value of $3,000, $16,000 is your new depreciable cost. Now that you have your new depreciable costs, we need to determine how much depreciation to take for the remaining service life. It tells us that our service life is now going to be 7 years, and we've already taken 3 years worth of depreciation. So if we've taken 3 years worth of depreciation and the useful life is going to be 7 years, we have 4 excuse me. So we have a new remaining service life of 4 years. Therefore, our depreciable cost divided by 4 equals $4,000 of depreciation that you would take for the remaining useful life. So if you'll look here, you'll see book value at the end of year 3, $19,000. Remember, we calculated that by taking the $7,000 of depreciation times 3 to get $21,000. $21,000 from your cost of 40 gives you the book value of 19. Our new residual cost is 3, so our new depreciable cost is 16. 16 divided by the remaining service life of 4, we should take depreciation each year of $4,000.